Yeah, the earnings call's ongoing, Carl. And Goldman Sachs, as you said, trading lower, and that's largely due to costs coming in higher than expected. Operating expenses were $7.3 billion, ahead of the forecast of $6.7. Most of that surprise coming via compensation and benefits. And at the start of the earnings call, CEO David Solomon said, quote, "I want to reiterate the importance I place on investing in the people of Goldman Sachs," end quote, and that it was, quote, "a personal priority of mine that we invest in their success." New CFO Dennis Coleman added that they are committed to rewarding top talent in a competitive labor environment. But he also noted that full-year compensation ratio of 30% is in fact 2% lower than 2020. Within the non-comp costs, Coleman said, quote, "Technology spend and engineering expense is a strategic expense for the firm. That's one area where we expect to continue to invest," end quote. But he also noted that there are levers to pull to adjust that spend and that the bulk of the non-comp costs were transaction related. It did therefore feel like a different tone in the guide on the costs to JP Morgan, but nonetheless, shares are selling off sharply. Now, despite the stock trading lower, it was comfortably a record year for revenues and earnings. And the quarter itself was strong on the top line. Only equity trading was really a miss compared to what estimates were, $2.1 billion. The forecast was for $2.4 billion. Fixed income trading, asset management and consumer were all largely in line and contributed, therefore, to that record year. And investment banking was once again very strong, up 45% year over year, impressively even up 3% quarter over quarter. And on the call, the CFO, Dennis Coleman, said, quote, "We start the year with an investment banking backlog that is significantly higher than where we started 2021, despite record revenues." The stock, though, guys, as we mentioned, down 6 or 7%.
Yeah, well, stocks of all the banks down again this morning, despite higher yields. You know, you mentioned this, but give us a little more information in terms of how JP Morgan's discussion of expenses being higher perhaps than had been anticipated differs from that of Goldman's.
Yeah, so in JP Morgan's release on the final slide, it quite clearly stated that we're upping our guidance for expenses for the year ahead to $77 billion. There was no doubt about that, and on the call there was tons of questions about it, and they couldn't give hard clarification. It was just a one-year increase, so people extrapolated from that we don't know how long these higher costs will go on. On the Goldman Sachs call just now, we did get a hint of that. In fact, just before I came on with you, Dennis Coleman, the CFO, said $4.5 to $5 billion of expenses from last year was tech and engineering, and you should expect to keep investing in that area. But that is a small part of their total comp, their total expenses, and the bulk of the surprise this quarter came in the compensation expense, and they have been quite clear on the call that there are levers they can pull if next year and the year ahead isn't a record year like the year past on that front. But in this current environment, on a sell-off day, you're not going to see the shares perform well when you do have a bit of a miss on the bottom line and expenses are a little high. And you know, we'll see if that continues. Don't forget as well, Goldman had a great year last year and started the year pretty strongly in terms of share price performance. But look, what is it down? 8%. It's a pretty sharp sell-off.